The Indian stock market is making history, unfortunately, for the wrong reasons. On Friday, Indian stock benchmarks saw a deep sell-off with the Sensex index crashing over 1,400 points and the Nifty 50 index ending nearly 2% lower, marking its worst losing streak in decades. The Nifty 50 has fallen for 5 consecutive months, its longest losing run in 29 years. In fact, while the benchmark indices ended little change despite turbulent activity on Thursday, the market breadth or the advance to decline ratio, in fact, ended up hitting a 5-year low. And this further indicates that the uncertainty is far from over, with small and mid-cap stocks falling the most. Investors have been selling off their holdings non-stop due to rising economic uncertainty, dismal company profits, and ongoing overseas outflows. The Nifty and the Sensex have fallen over 4% in February alone, bringing their losses to 14% and 13.2% respectively since their record highs in September. Investors who rejoiced at record highs 4 months ago are now dealing with losses. Experts warn that stock values are still high despite the steep decline, and views from fund managers and analysts are divided. Shankar Sharma, founder of GQuant and First Global, predicts Indian markets to go through a rough time over the next 5 years. And analysts at Kotak Institutional Equities remain cautious and said that the markets do not appear to be hitting a bottom anytime soon. Investors are preparing for what may be an extended period of declines. And this comes amid widespread market volatility and India's most difficult market phase in recent memory. Donald Trump's tariff threat has darkened the clouds for global markets. But not everyone is pessimistic. Citigroup takes a contrasting approach by raising its rating on Indian stocks from neutral to overweight. The Nifty index has positive seasonality in March. According to JM Financial, in March, the index closed in the green in 7 years of the last decade. Over the last 30 years, there have been a total of just 8 major corrections. The latest 20% fall from their all-time highs is hardly the worst drop in those 3 decades. Although increased volatility is sometimes associated with sell-offs, this time appears different. The Nifty has lost almost 1.5% of its value. But the India VIX has declined for 6 consecutive sessions, and this suggests that traders are not going into a frenzy to purchase hedging strategies because they anticipate a possible rebound. Stock bulls are hoping for better news next month after February's wild ride. And for more on this, with us on the broadcast is Amrish Baliga, an independent market analyst. Thanks very much for being here. Let me begin by asking you, how do you see this prolonged market slump in the Indian markets? What's your reaction?
See, it's like rightly said, it's been falling for the last 5 months, and we're already down about 15%. And this fall can increase further from here. We can still fall another 5% more from here. But most importantly, it's going to be painful. That's because huge number of investors who came in post-COVID in the last 5 years, they've never witnessed a huge fall like this. The corrections earlier used to be shallow, and every time it fell, investors bought, the markets bounced back. So the theory that markets can move only one way, and that's up, and every correction is a buying opportunity, that proved right for a decently long time. However, now this theory is not working, and most of them are sitting on steep losses. So it's a question of loss of confidence and trust. We need to see as to how long they need to come back to the markets. How long they take to come back to the markets. Normally, I would say they take long. Some of them never even come back to the markets. And it's a new breed of investors who take the markets to new highs. And that is still some time away. So valuation-wise, I think we have come to decent levels, though it may not be a screaming buy at this point of time. But I think the valuations are decent. In fact, I was advising my investors to remain in cash to the extent of about 40%. This was about 6 months back when the markets were too stretched. But I think now is the time to start investing. So nobody knows where the bottom is, but surely I think the valuations have become supportive at this point of time. So I think it's a good time to start investing fresh.
Right, and beyond the geopolitical uncertainties, what domestic factors, according to you, are contributing to this declining trend in the Indian markets?
So see, the earnings were disappointing. I mean, it started in Q1, and people ignored that. Then Q2 earnings also were slightly lower, but people thought it was a short-term phenomena. But when Q3 again we saw that the earnings are disappointing, I think that's the time it took its toll. And along with this, if you look at the macro numbers, the GDP data, GST data, I mean, all these are showing signs of a slowdown. I mean, we are still growing. And India would be among the few countries or the economies which will continue to grow if you're talking of the next decade or two. So we're not even talking of a recession. But then, again, markets is all about expectations and delivery. So expectations were high and they were moving up in the last 4 years, whereas performance started declining. And that led to disappointment, and because of which the sentiments got affected, and because of which we saw the markets correcting. But I would say that when markets correct like this, it's an opportunity because going ahead, we continue to see India performing.
Do you see or expect any turnaround in the Indian markets? And if yes, how will that happen according to you?
See, one thing is 2025 is going to be painful. But then a turnaround, yes, I think we should see that in 2025 itself, because I see some action from the government in terms of faster execution of the infra projects. Because in 2024, we had a record budgeted, for the infra projects. But then what went wrong was the execution. So I see execution improving in 2025, and that could be one of the triggers. We could see RBI reducing rates going ahead to push capex in the industry. And I think more importantly, it's from investing community's perspective. I think the expectations will now get calibrated. So going ahead, we could see a few surprises from the earnings. I'm talking of possibly Q1 next year, Q1 of FY26, Q2 of FY26. I think that is what could be the trigger for the markets to bounce back.
All right, we're leaving it there for the moment. Thanks very much for joining us and sharing your perspectives.